Investing 101, A Beginner's Guide to Stock Market Success. Written by Ronnie Rowland. Published by Growth Literacy Lounge. Introduction. Have you ever felt overwhelmed by the complexities of the stock market? Does the idea of investing your hard-earned money seem daunting? You are not alone. Many people find the stock market intimidating, filled with jargon and seemingly unpredictable movements. Yet, despite these challenges, the stock market remains one of the most powerful tools for building wealth and securing financial independence. Imagine a future where your money works for you, growing steadily over time, and providing you the financial freedom to live on your terms. Picture being able to fund your dream retirement, support your children's education, or make that major purchase you've always wanted. This future is within your reach, starting with understanding how to invest in the stock market. We begin by exploring what the stock market is and how it functions. Understanding the basics is crucial before diving into the different types of stocks and investment strategies. Each chapter builds on the previous one, ensuring a comprehensive learning experience that equips you with practical tools and insights. By the end of this book, you will have a solid understanding of navigating the stock market, making informed investment decisions, and building a resilient portfolio. You will be equipped with the tools and confidence needed to transform your financial future. Imagine a future where your money works for you, growing steadily over time and providing you the financial freedom to live on your terms. Picture being able to fund your dream retirement, support your children's education, or make that major purchase you've always wanted. This future is within your reach, starting with understanding how to invest in the stock market. This book is designed to demystify the investing world, breaking complex concepts into clear, actionable steps. Whether you are a complete beginner or have some experience, this guide will give you the knowledge and confidence to start investing successfully. The journey to financial transformation begins with a single step. Are you ready to take that step? Are you prepared to unlock the potential of the stock market and achieve your financial goals? If so, let's embark on this journey together, starting with the foundational knowledge to set you on the path to success. By the end of this book, you will have a solid understanding of navigating the stock market, making informed investment decisions, and building a resilient portfolio. You will be equipped with the tools and confidence needed to transform your financial future. Subscribe, comment, and like. Be part of the movement shaping the future of learning and growth. Let's begin. Chapter 1. What is the stock market? Have you ever wondered how the stock market works? The stock market might seem complex and mysterious, but at its core, it's a straightforward system for buying and selling company ownership shares. Think of it as a marketplace where you can invest in businesses, hoping to earn a return as these companies grow and succeed. The stock market has a long history, from the early 1600s when the first modern stock exchange was established in Amsterdam. Over the centuries, it has evolved into a global network of exchanges where millions of transactions occur daily. This bustling environment can appear chaotic, but it operates on simple principles of supply and demand. Understanding the basics. Stocks, also known as shares or equities, represent partial ownership in a company. When you buy a stock, you purchase a piece of that company. If the company performs well, the value of your stock may increase, allowing you to sell it for a profit. Conversely, the stock's value may decrease if the company performs poorly. How the stock market works. Stock exchanges. These are formal organizations where stocks are bought and sold. The most well-known exchanges include the New York Stock Exchange and the Nasdaq. Companies list their stocks on these exchanges, making them available for public trading. Stock prices fluctuate based on supply and demand. If more people want to buy a stock than sell it, the price goes up. If more people want to sell than buy, the price goes down. Various factors influence stock prices, including company performance, economic indicators, and market sentiment. Market participants. The stock market comprises various participants, including individual investors, institutional investors such as mutual funds and pension funds, and traders. Each participant plays a role in determining stock prices through their buying and selling activities. The stock market serves several critical functions. Capital formation. Companies raise capital by issuing stocks, which they use to fund growth and operations. Wealth generation. Investors can build wealth by purchasing stocks that appreciate and pay dividends. Economic indicator. The stock market reflects the overall health of the economy. Rising markets typically indicate economic growth, while falling markets may signal economic challenges. Why it matters to you. Investing in the stock market can be a powerful way to grow wealth over time. By understanding how it works, you can make informed decisions that help you achieve your financial goals. Whether saving for retirement, a significant purchase, or simply looking to grow your assets, the stock market offers opportunities for long-term economic success. Now that you understand the stock market and how it functions, it's time to explore the different types of stocks available. In the next chapter, we'll dive into the various categories of stocks and why choosing the right ones is crucial for your investment strategy. Chapter 2: Types of Stocks. Do you know the difference between standard and preferred stocks? Understanding the types of stocks available is essential for any beginner investor. Stocks can be categorized in various ways, and each type has its characteristics, benefits, and risks. By familiarizing yourself with these differences, you can make more informed investment decisions that align with your financial goals. Common stocks. Common stocks are the most prevalent type of stock that investors buy. When you purchase common stock, you own a piece of the company and have voting rights on certain corporate decisions, typically at the annual shareholder meeting. Common stockholders also receive dividends, portions of a company's earnings distributed to shareholders, although these are not guaranteed. Benefits of common stocks. Growth potential. Common stocks can potentially have significant capital appreciation if the company performs well. Voting rights. Shareholders can vote on important issues, such as electing the board of directors. Dividends. Some companies pay regular dividends to their common stockholders, providing a source of income. Risks of common stocks. Volatility. The value of common stocks can be highly volatile, with prices fluctuating based on market conditions. Subordinate to preferred stocks. In the event of a company's liquidation, common stockholders are paid after preferred stockholders and creditors. Preferred stocks. Preferred stocks represent a different class of ownership in a company. These stocks typically do not provide voting rights but offer a fixed dividend, which is paid out before any dividends are given to common stockholders. Preferred stock is often seen as a hybrid between common stock and bonds. The benefits of preferred stocks. Fixed dividends. Preferred stockholders receive regular, fixed dividends, providing a predictable income stream. Priority in liquidation. In bankruptcy, preferred stockholders are paid before common stockholders, but after debt holders. Less volatile. Preferred stocks tend to be less volatile than common stocks, offering more stability. Risks of preferred stocks. Limited growth potential. Preferred stocks typically do not appreciate as much as common stocks. No voting rights. Preferred stockholders generally do not have voting rights on corporate matters. Other types of stocks. Growth stocks. These shares belong to companies that are anticipated to grow faster than the average rate of other companies. Growth stocks usually do not distribute dividends, as companies use their earnings to support future expansion. Investors are interested in growth stocks for their potential to appreciate over time. Value stocks. These are shares in companies considered undervalued by the market. These stocks trade at lower prices than their fundamentals, such as earnings or sales. Value investors look for stocks that they believe are priced below their true worth, offering a potential bargain. Dividend stocks. These company shares regularly return a portion of their earnings to shareholders as dividends. Dividend stocks can provide a steady income stream, making them attractive to income-focused investors like retirees. Choosing the right stocks. Your investment goals and risk tolerance will determine the stocks best suited for your portfolio. Growth stocks may be ideal if you're seeking capital appreciation and are willing to accept higher volatility. On the other hand, if you prefer stability and regular income, dividend or preferred stocks might be a better fit. With the basics of stock types under our belt, it's time to learn about the different investment strategies that can help you maximize your returns. In the next chapter, we'll explore various investment strategies, helping you determine the best approach for your financial goals and risk tolerance. Chapter 3: Investment Strategies. What's your game plan for investing in the stock market? Having a solid investment strategy is crucial for successful investing. Your plan will guide your decisions, helping you stay focused on your financial goals and manage risks effectively. In this chapter, we'll cover several popular investment strategies, exploring the pros and cons of each and how to choose one that aligns with your goals and risk tolerance. Value investing. Value investing involves buying stocks that appear to be undervalued by the market. Value investors look for companies with solid fundamentals, such as low price-to-earnings (PE) ratios, high dividend yields, and solid balance sheets. The idea is to purchase and hold stocks at a discount until the market recognizes their value. Benefits of value investing. Potential for high returns. Buying undervalued stocks can lead to significant gains when the market corrects the mispricing. Dividends. Many value stocks pay dividends, providing a regular income stream. Lower risk. Investing in established companies with strong fundamentals can be less risky than investing in high-growth startups. Risks of value investing. Timing. Identifying truly undervalued stocks can be challenging, and it may take time for the market to recognize their value. Value traps. Sometimes, stocks are undervalued for declining business prospects, which can lead to poor investment outcomes. Growth investing. Growth investing focuses on companies expected to grow at an above-average rate compared to others. Growth investors seek companies with solid revenue and earnings growth, often in emerging industries like technology or biotechnology. Benefits of growth investing. High potential returns. Growth stocks can offer substantial capital appreciation if the companies achieve their growth targets. Innovative companies. Growth investors often invest in cutting-edge companies that are driving industry advancements. Risks of growth investing. Volatility. Growth stocks can be highly volatile, with significant price swings based on market sentiment and company performance. No dividends. Many growth companies reinvest profits into the business, often not paying dividends. Dividend investing. Dividend investing involves buying stocks that pay regular dividends. This strategy is popular among investors seeking steady income, such as retirees. Dividend stocks can provide a reliable income stream, and reinvesting dividends can significantly enhance long-term returns. Benefits of dividend investing. Steady income. Dividends provide a regular income stream, which can be especially valuable during market downturns. Compounding returns. Reinvesting dividends can accelerate portfolio growth over time. Lower volatility. Dividend-paying stocks are often more stable and less volatile than non-dividend-paying stocks. Risks of dividend investing. Limited growth. Companies that pay high dividends may have less potential for capital appreciation than growth stocks. Dividend cuts. Companies can reduce or eliminate dividends if they experience financial difficulties. Index investing. Index investing involves buying shares of an index fund or exchange-traded fund (ETF) that tracks a specific market index, such as the S&P 500. This strategy offers broad market exposure, low fees, and a passive approach to investing. Benefits of index investing. Diversification. Index funds provide exposure to a wide range of stocks, reducing the impact of individual stock performance on your portfolio. Low costs. Index funds typically have lower management fees compared to actively managed funds. Or consistent returns. Index funds aim to match the performance of the market, which historically has provided solid long-term returns. Risks of index investing. Market risk. Index investing exposes you to the overall market's ups and downs, so your portfolio will mirror market performance. Limited upside. While index funds offer consistent returns, they may not outperform the market, limiting potential gains. Choosing your strategy. Selecting the right investment strategy depends on your financial goals, risk tolerance, and investment horizon. If you're looking for steady income, dividend investing might be suitable. Growth investing could be the way to go if you seek capital growth and are willing to accept higher volatility. For a more balanced approach, consider index investing, which offers diversification and low costs. Once you've chosen a strategy, the next step is to learn how to research and pick the right stocks. In the next chapter, we'll delve into the details of stock research, helping you identify the best investment opportunities and make informed decisions. Chapter 4. How to research stocks. How do you determine if a stock is worth investing in? Research is the cornerstone of successful investing. It involves analyzing a company's financial health, market position, and growth prospects to determine if its stock is a good investment. This chapter will explore the key metrics and tools used to evaluate stocks, such as financial ratios, company reports, and analyst recommendations. By the end, you'll have a solid understanding of how to conduct thorough stock research. Understanding financial statements. The first step in researching a stock is to examine the company's financial statements. These documents provide a snapshot of the company's financial health and performance. The three primary financial statements are: income statement. This statement shows the company's revenue, expenses, and profit over a specific period. Key metrics to look for include: revenue, the total income generated by the company; net income, the profit after all expenses have been deducted from revenue; earnings per share. A portion of a company's profit is allocated to each outstanding share of common stock. Balance sheet. This statement provides a snapshot of the company's assets, liabilities, and shareholders' equity at a specific time. Key metrics include: assets, resources owned by the company, such as cash, inventory, and property; liabilities, obligations the company owes to others, such as loans and accounts payable; shareholders' equity, the residual interest in the company's assets after deducting liabilities; cash flow statement. This statement shows the company's cash inflows and outflows over a specific period. Key metrics include: operating cash flow, cash is generated from the company's core business operations; investing cash flow, cash is used for investments in assets and acquisitions; financing cash flow, cash is used for financing activities, such as issuing or repurchasing stock and paying dividends. Key financial ratios. Financial ratios help compare companies and assess their financial health. Some crucial ratios include: price to earnings ratio. This ratio measures the price of a stock relative to its earnings per share. A high ratio may indicate that a stock is overvalued, while a low PE ratio may suggest it's undervalued. Price to book ratio. This ratio compares a company's market value to its book value. A lower ratio may indicate that a stock is undervalued. Debt to equity ratio. This ratio measures a company's financial leverage by comparing its total liabilities to shareholders' equity. A high debt to equity ratio may indicate higher financial risk. Qualitative analysis. In addition to quantitative analysis, qualitative factors are crucial in stock research. These include: management. Assess the quality and track record of the company's leadership team. Competitive advantage. Determine if the company has a sustainable competitive advantage, such as a strong brand, patented technology, or a significant market share. Industry trends. Evaluate the company's position within its industry and the broader market trends that could impact its performance. Research tools and resources. Several tools and resources can assist you in your stock research. Financial news websites. Platforms like Bloomberg, Reuters, and CNBC provide up-to-date news and analysis on companies and markets. Stock screeners. Tools like FinViz and Yahoo Finance allow you to filter stocks based on specific criteria and metrics. Analyst reports. Investment banks and financial institutions publish research reports that provide insights and recommendations on various stocks. Making informed decisions. By combining quantitative analysis with qualitative factors, you can make more informed investment decisions. It's important to stay objective and avoid letting emotions drive your choices. Regularly reviewing and updating your research is also crucial, as market conditions and company performance can change over time. Understanding how to research stocks is vital, but managing risk is equally important. In the next chapter, we'll delve into risk management in investing, helping you protect your investments and achieve long-term success. Chapter 5. Risk Management. Every investment carries a certain level of risk, and understanding how to manage and mitigate these risks is crucial for long-term success. This chapter will explore risk management strategies, including diversification, setting stop-loss orders, and understanding risk tolerance. By implementing these techniques, you can protect your investments and navigate the uncertainties of the stock market with confidence. Understanding risk. Risk in investing refers to the potential for losing some or all of your investment. Different types of risk include market risk, the risk of losses due to overall market downturns, company-specific risk, the risk associated with individual companies, such as poor management or product failures, liquidity risk. There is a risk of being unable to sell an investment quickly without a significant price reduction. Interest rate risk. The risk is that interest rate changes will negatively affect your investment's value. Diversification. Diversification involves spreading your investments across a range of assets to minimize risk. The concept is that by having a diverse portfolio, the negative impact of a single investment's poor performance can be mitigated. One way to achieve diversification is by investing in various sectors. Spread your investments across various industries, such as technology, healthcare, and consumer goods. Investing in different asset classes. Include a mix of stocks, bonds, real estate, and other asset classes in your portfolio. Geographic diversification. Diversify your investments by choosing companies from various countries and regions to reduce exposure to geopolitical risks. Setting stop-loss orders. A stop-loss order is placed with a broker to buy or sell a stock when it reaches a specific price. This strategy helps limit losses by automatically selling a stock if its price falls below a predetermined level. Setting stop-loss orders can prevent emotional decision-making and ensure you stick to your risk management plan. Understanding your risk tolerance. Risk tolerance refers to one's ability and willingness to endure market volatility and potential losses. It is influenced by factors such as one's financial situation, investment goals, and time horizon. Understanding one's risk tolerance is essential for choosing the right investments and developing a strategy that aligns with one's comfort level. Steps to assess your risk tolerance. Evaluate your financial situation. Consider your income, savings, and financial obligations. Set clear investment goals. Define your short-term and long-term objectives. Determine your time horizon. How long you plan to hold your investments can impact your risk tolerance. Longer time horizons generally allow for higher risk tolerance. Assess your emotional response. Reflect on how you react to market fluctuations and potential losses. Setting investment goals. Clearly define your financial objectives and how much risk you will take to achieve them. Diversifying your portfolio. Spread your investments across various asset classes, sectors, and geographic regions. Regular portfolio reviews. Periodically review and adjust your portfolio to ensure it remains aligned with your goals and risk tolerance. Using stop-loss orders. Implement stop-loss orders to limit potential losses and protect your investments. The importance of staying disciplined. Staying disciplined and adhering to your risk management plan is crucial for long-term success. It's easy to be swayed by market trends and emotions, but sticking to your strategy will help you navigate market volatility and achieve your financial goals. Now that you know how to manage risk, it's time to explore the practical steps of opening a brokerage account and placing your first trade. In the next chapter, we'll guide you through selecting the right brokerage and understanding the trading process. Chapter 6. Setting up a brokerage account. How do you choose the right brokerage for your needs? Opening a brokerage account is your gateway to the stock market. The right brokerage can provide the tools, resources, and support you need to make informed investment decisions. In this chapter, we'll guide you through selecting a brokerage, understanding the different types of accounts, and the steps to open an account. Additionally, we'll cover essential considerations like fees, account minimums, and trading platforms. Choosing a brokerage. There are numerous brokerages, each offering different features and services. Here are some key factors to consider when selecting a brokerage. Fees and commissions. Look for a brokerage with competitive fees and low or zero trade commissions. Be aware of other potential costs, such as account maintenance fees, inactivity fees, and fees for additional services. Account minimums. Some brokerages require a minimum deposit to open an account. Choose a brokerage that aligns with your financial situation and investment goals. Trading platform. A user-friendly trading platform is essential for executing trades and managing your investments. Look for platforms that offer intuitive interfaces, robust research tools, and real-time data. Customer service. Having reliable customer service is extremely valuable, especially for those who are new to the field. It's important to ensure that the brokerage provides support through various channels like phone, email, and live chat. And investment options. Ensure the brokerage offers various investment options, including stocks, bonds, mutual funds, ETFs, and other securities. Research and education. Access to quality research and educational resources can help you make informed decisions. Look for brokerages that provide comprehensive market analysis, research reports, and educational content. Different kinds of brokerage accounts. There are several brokerage accounts, each with its features and benefits. The main types include individual brokerage account. This is a standard account opened by an individual for personal investing. It offers flexibility and access to a wide range of investment options. Joint brokerage account. A joint account is shared by two or more individuals, typically spouses or family members. It allows for combined resources and shared investment management. Retirement accounts. These accounts, such as individual retirement accounts IRAs and Roth IRAs, offer tax advantages for long-term retirement savings. Contributions to these accounts may be tax-deductible, and investment gains can grow tax-free or tax-deferred. Custodial accounts. An adult sets up these accounts to benefit a minor. They allow for the management of investments until the minor reaches a certain age, typically 18 or 21. Opening a brokerage account is a straightforward process. Here are the general steps. Choose a brokerage. Select a brokerage that meets your needs based on the factors mentioned earlier. Complete an application. Fill out the brokerage's online application form, providing personal information such as your name, address, social security number, and employment details. Verify your identity. Most brokerages require you to verify your identity by providing a copy of a government-issued ID, such as a driver's license or passport. Fund your account. Deposit funds into your brokerage account using a bank transfer, wire transfer, or check. Some brokerages may also accept credit or debit card payments. Select your account type. You can open a brokerage account as an individual, joint, or retirement account. Agree to terms and conditions. Please review and accept the brokerage's terms and conditions, including their fee schedule and trading policies. Start trading. Once your account is funded and set up, you can start researching stocks and making trades. Important considerations. Security. Ensure the brokerage is a member of the Financial Industry Regulatory Authority and the Securities Investor Protection Corporation, which provide regulatory oversight and protection for investors. Mobile access. If you prefer to manage your investments on the go, choose a brokerage with a robust mobile app that offers trading, research, and account management features. With your account set up, it's time to make your first trade. In the next chapter, we'll walk through the trading process step by step, ensuring you feel confident and prepared to start investing in the stock market. Chapter 7. Making your first trade. Making your first trade is an exciting step in your investment journey. It can also be daunting if you're new to the stock market. In this chapter, we'll guide you through making your first trade, from choosing a stock to executing the trade. We'll explain the differences between market orders, limit orders, and other order types, ensuring you feel confident and prepared for your first stock purchase. Choosing a stock. Before making a trade, you must decide which stock to buy. Here are some steps to help you choose. Research. Use the skills you learned in the previous chapter to research potential stocks. Look at financial statements, key ratios, and qualitative factors like management quality and competitive advantages. Set your criteria. Determine the most essential criteria, such as growth potential, dividend yield, or market sector. This will help narrow down your options. Use stock screeners. Stock screeners can help you filter stocks based on your criteria. Many brokerages offer these tools, or you can find them on financial news websites. Analyze market trends. Consider current market trends and economic indicators affecting the stock's performance. This can give you a sense of the stock's potential for growth or decline. Placing a trade. Once you've chosen a stock, it's time to place your trade. Here's a step-by-step guide. Log into your brokerage account. Access your brokerage account through the website or mobile app. Find the stock. Use the search function to locate the stock you want to buy. You'll need to know the stock's ticker symbol, a unique series of letters representing the stock on an exchange. Choose the trade type. Decide whether you want to buy or sell the stock. Since this is your first trade, you'll be buying. Enter the quantity. Specify the number of shares you want to purchase. Consider the total cost, including any fees or commissions. Select the order type. You can place several types of orders, each with advantages and disadvantages. Types of orders. Market order. This is the simplest and most common type of order. A market order immediately buys or sells the stock at the current market price. It ensures the trade is executed quickly, but doesn't guarantee the price you'll get. Limit order. A limit order allows you to specify the maximum price you'll pay to buy a stock, or the minimum price you will accept to sell a stock. The trade will only execute if the stock reaches your specified price. This gives you more control over the price, but doesn't guarantee the trade will be executed. Stop order. A stop-loss order, also known as a stop order, reduces losses. When the stock reaches a set price called the stop price, it changes into a market order. For example, if you buy a stock at $50 and set a stop order at $45, the stock will be sold if the price drops to $45, limiting your loss. Stop limit order. This combines a stop order with a limit order. Once the stop price is reached, the order becomes a limit order rather than a market order. This can help protect against price volatility during execution. Review your order. Double-check all your order details, including the stock symbol, quantity, order type, and fees. Place the order. Submit your order. You'll receive a confirmation once the trade is executed. Monitoring your trade. After placing your trade, it's essential to monitor its performance. Here are some tips. Track the stock. Keep an eye on the stock's price and news related to the company. This will help you stay informed about factors that might affect your investment. Create notifications. Many brokerages allow you to set price alerts, notifying you when a stock reaches a specific price. This can help you stay on top of your investments without constantly checking the market. Review your strategy. Regularly review your investment strategy and adjust your portfolio as needed. This will help ensure your investments remain aligned with your goals. After making your first trade, keeping track of your investments is crucial. In the next chapter, we'll discuss how to monitor and manage your portfolio effectively, ensuring you stay on track to achieve your financial goals. Chapter 8. Monitoring your portfolio. Investing doesn't stop at buying stocks. Regularly monitoring your portfolio is essential to stay aligned with your financial goals and adjust to market changes. This chapter will cover tracking your investments, assessing performance, and making necessary adjustments. We'll also discuss tools and apps that can help simplify this process. Why monitoring is important. Track progress. Ensure your investments are performing as expected and progressing towards your financial goals. Identify underperformers. Spot stocks that are not meeting your expectations so you can decide whether to hold or sell them. Stay informed. Keep up with market trends and company-specific news that might affect your investments. Rebalance. Adjust your portfolio periodically to maintain your desired asset allocation and risk level. How to monitor your portfolio. Set up a system. Establish a routine for checking your portfolio. Depending on your investment strategy and goals, this could be weekly, monthly, or quarterly. Use tools and apps. Many brokerages offer portfolio tracking tools that provide real-time updates on your investments. Standalone apps like Personal Capital, Morningstar, and Yahoo Finance can also help you track and analyze your portfolio. Review key metrics. Focus on critical performance indicators such as total return, your investment's overall gain or loss, including dividends and capital gains, annualized return, the average annual return of your portfolio over a specific period, volatility. The degree of variation in your portfolio's returns indicates risk. The degree of variation in your portfolio's returns indicates risk. Diversification. Assess the mix of assets in your portfolio to ensure it remains balanced. Stay updated on news. Follow financial news and updates about the companies in your portfolio. This can provide insights into potential opportunities and risks. Compare performance. Benchmark your portfolio's performance against relevant indices, such as the S&P 500 or other sector-specific indices. This helps you gauge how well your investments perform relative to the market. Rebalancing your portfolio. Over time, some investments may grow faster than others, altering your original asset allocation. Rebalancing involves adjusting your portfolio to maintain your desired allocation. Here's how to do it. Assess current allocation. Take a moment to compare your current asset allocation with your desired target allocation. This will help you identify any significant deviations between the two. Sell overweight assets. Sell some assets that have grown disproportionately to bring them back in line with your target allocation. Buy underweight assets. Use the proceeds from selling overweight assets to purchase more underweight assets, ensuring a balanced portfolio. Consider taxes and fees. Consider the tax implications and transaction fees associated with buying and selling assets. Look for tax-efficient strategies, such as using tax-advantaged accounts or offsetting gains with losses. Managing emotional responses. Investing may bring up emotions, especially when the market is unpredictable. Here are a few suggestions for handling those feelings. Stay disciplined. Stick to your investment strategy and avoid making impulsive decisions based on short-term market movements. Focus on long-term goals. Keep your long-term objectives in mind and avoid getting swayed by temporary market fluctuations. Avoid overchecking. Constantly checking your portfolio can lead to anxiety and hasty decisions. Establish a routine for monitoring and stick to it. Using alerts and notifications. Many brokerages and financial apps allow you to set up alerts for significant events, such as stock price changes, earnings reports, and market news. These alerts can help you stay informed without constantly checking your portfolio. Monitoring is essential, but understanding market trends and indicators can give you an edge. The next chapter will explore market analysis techniques, helping you make informed decisions based on broader economic signals. Chapter 9. Understanding market trends. Market trends and economic indicators play a significant role in stock performance. Understanding these trends can help you make informed investment decisions and anticipate market movements. In this chapter, we'll introduce you to technical and fundamental analysis basics, helping you understand how to read market trends and make informed decisions based on broader economic signals. Technical analysis. Technical analysis involves examining historical price and volume data to predict future market behavior. This approach is based on the belief that past trading activity and price changes can indicate future price movements. Here are some key concepts and tools used in technical analysis. Charts. Price charts are the primary tool in technical analysis. Common types include line charts, bar charts, and candlestick charts. Each chart type provides a different perspective on price movements over time. Trends. Identifying trends is crucial in technical analysis. Trends can be upward bullish, downward bearish, or sideways consolidation. Trend lines are drawn on charts to highlight these movements and potential breakout points. Support and resistance. Support levels are prices at which a stock tends to find buying interest, preventing it from falling further. Resistance levels are prices at which a stock faces selling pressure, preventing it from rising further. These levels help identify potential entry and exit points. Indicators and oscillators. Technical indicators, such as moving averages, relative strength index, and moving average convergence divergence, provide insights into market momentum and potential reversals. These tools help traders identify overbought or oversold conditions. Fundamental analysis. Fundamental analysis evaluates a stock's intrinsic value by examining related economic, financial, and other qualitative and quantitative factors. This approach is based on the belief that the stock market may misprice a security in the short term, but its actual value will be recognized over the long term. Critical components of fundamental analysis include economic indicators. Economic data, such as GDP growth, unemployment rates, inflation, and interest rates, provide insights into the economy's overall health and impact on the stock market. Company financials. Analyzing a company's financial statements, including its income, balance sheet, and cash flow statement, helps assess its economic health, profitability, and growth prospects. Industry analysis. Understanding the dynamics of a company's industry is essential. This includes evaluating market size, competition, regulatory environment, and technological advancements. Management and governance. Assessing the quality of a company's management team and its corporate governance practices can provide insights into its ability to execute its strategy and manage risks. Combining technical and fundamental analysis. While some investors prefer one method over the other, combining technical and fundamental analysis can provide a more comprehensive view of a stock's potential. Here's how you can integrate both approaches. Use fundamental analysis for stock selection. Fundamental analysis can identify stocks with robust financial health, solid growth prospects, and attractive valuations. Apply technical analysis for timing. Once you've selected a stock, use technical analysis to determine the best entry and exit points. Look for technical indicators that support your fundamental analysis and confirm the stock's potential direction. Keeping up with market news. Staying informed about market news and events is crucial for understanding market trends. Here are some sources to keep you updated. Financial news websites. Platforms like Bloomberg, Reuters, and CNBC provide real-time news and analysis on the stock market and the global economy. Economic calendars. Websites like investing.com and MarketWatch offer economic calendars that list upcoming financial events and indicators, helping you anticipate market movements. Analyst reports. Investment banks and financial institutions publish research reports that offer insights and recommendations on various stocks and sectors. Making informed decisions. Understanding market trends and economic indicators helps you make informed investment decisions. Combining technical and fundamental analysis lets you identify attractive investment opportunities and determine the best times to buy or sell stocks. Regularly reviewing and updating your analysis ensures you stay aligned with market conditions and investment goals. Now that you can analyze market trends, it's essential to understand the tax implications of your investments. In the next chapter, we'll delve into how taxes can impact your returns and explore strategies to optimize your tax situation. Chapter 10. Tax implications of investing. How can taxes affect your investment returns? Taxes are an often overlooked aspect of investing, but can significantly impact your overall returns. Understanding the tax implications of your investments allows you to make more informed decisions and potentially reduce your tax burden. In this chapter, we'll explain the various taxes associated with investing, including capital gains taxes and dividends, and discuss strategies to optimize your tax situation. Understanding capital gains taxes. Capital gains taxes are levied on the profit you make from selling an investment for more than you paid. There are two types of capital gains taxes. Short-term capital gains. These are gains on investments held for 1 year or less. Short-term capital gains are taxed at your ordinary income tax rate, which can be significantly higher than long-term capital gains rates. Long-term capital gains. These are gains on investments held for more than 1 year. Long-term capital gains are taxed at lower rates, which vary depending on your income level. Most taxpayers' long-term capital gains tax rate is 0%, 15%, or 20%. Dividends and taxes. Dividends are distributions of a company's earnings to its shareholders. They can be taxed as either ordinary income or qualified dividends, each with different tax implications. Ordinary dividends. These are taxed at your ordinary income tax rate. They are reported on your tax return as ordinary income. Qualified dividends. These are taxed at the lower long-term capital gains tax rates. To qualify, dividends must be paid by a U.S. corporation or a qualified foreign corporation, and you must meet specific holding period requirements. Tax-advantaged accounts. Using tax-advantaged accounts can help minimize your tax liability. Common types of tax-advantaged accounts include individual retirement accounts. Contributions to traditional IRAs may be tax-deductible, and the investments grow tax-deferred until withdrawn. Roth IRAs are funded with after-tax dollars, but qualified withdrawals are tax-free. 401k plans. These employer-sponsored retirement plans allow you to contribute pre-tax dollars, reducing your taxable income. Investments grow tax-deferred until withdrawn. Some employers also offer Roth 401k options, which provide tax-free withdrawals. Health savings accounts HSAs. Contributions to HSAs are tax-deductible, and withdrawals for qualified medical expenses are tax-free. HSAs can also serve as additional retirement savings vehicles, with tax-deferred growth and tax-free withdrawals for non-medical expenses after age 65. Tax loss harvesting. Tax loss harvesting involves selling investments that have declined in value to offset gains from other investments, thereby reducing your overall tax liability. Here's how it works. Sell losing investments. Identify investments that have lost value and sell them to realize the losses. Offset gains. Use the realized losses to offset capital gains from other investments. If your losses exceed your gains, you can deduct up to $3,000 of the remaining loss against your ordinary income. Reinvest wisely. Be mindful of the wash sale rule, which disallows the deduction if you repurchase the same or a substantially identical investment within 30 days before or after the sale. Keeping good records. Maintaining accurate records of your investment transactions is essential for tax reporting. Keep track of the following information: purchase dates and prices. Record the date and price of each investment you buy. Sale dates and prices. Record the date and price of each investment you sell. Dividends received. Keep track of all dividends received throughout the year. Brokerage statements. Retain your monthly and annual brokerage statements for reference and tax reporting. Consulting a tax professional. Tax laws and regulations can be complex and subject to change. Consulting a tax professional can help you navigate these complexities and optimize your tax situation. A tax advisor can provide personalized advice based on your financial circumstances and investment strategy. Taxes are one piece of the puzzle. Planning for the long term is equally crucial. The next chapter will discuss long-term investment planning, helping you create a strategy that evolves with your financial situation and goals. Chapter 11. Long-term investment planning. Long-term planning is critical to sustained investment success. It involves setting clear financial goals, creating a strategy to achieve them, and regularly reviewing and adjusting your plan as your circumstances change. This chapter will discuss the importance of long-term investment planning, the steps to create a comprehensive plan, and strategies to ensure your plan remains effective over time. Setting long-term goals. The first step in long-term investment planning is defining your financial goals. These goals will guide your investment strategy and help you stay focused. Common long-term goals include retirement. Determine how much money you'll need to retire comfortably and when you want to quit. Consider expected living expenses, healthcare costs, and desired lifestyle. Education. Plan for the cost of education for yourself or your children. This might include saving for college tuition, books, and other expenses. Major purchases. Set goals for significant future expenses, such as buying a home, starting a business, or taking a dream vacation. Wealth building. Aim to grow your overall net worth over time, ensuring financial security and the ability to pursue various life goals. Creating a long-term investment strategy. Once you've defined your goals, you can create an investment strategy to achieve them. Here are some critical steps. Determine your time horizon. Your time horizon is the length of time you plan to hold your investments. Longer time horizons generally allow for more aggressive investment strategies, as you have more time to recover from market fluctuations. Assess your risk tolerance. Evaluate your ability and willingness to endure market volatility and potential losses. Your risk tolerance will influence your asset allocation and investment choices. Choose an asset allocation. Asset allocation involves spreading investments across different asset classes such as stocks, bonds, and real estate to balance risk and reward. A diversified portfolio can help reduce risk while maximizing potential returns. Select investments. Based on your asset allocation, choose specific investments that align with your goals and risk tolerance. This might include individual stocks, mutual funds, ETFs, bonds, and other securities. Automate contributions. Set up automatic contributions to your investment accounts to ensure consistent saving and investing. This can help you stay disciplined and take advantage of dollar-cost averaging. Regularly reviewing and adjusting your plan. Your financial situation and goals may change, so regularly reviewing and adjusting your investment plan is essential. Here's how to do it. Schedule regular reviews. Review your investment portfolio and financial goals at least once a year. If your circumstances change significantly, more frequent reviews may be necessary. Evaluate performance. Assess the performance of your investments relative to your goals. Determine whether your portfolio is on track to meet your objectives. Rebalance your portfolio. Periodically rebalance your portfolio to maintain your desired asset allocation. This involves selling overperforming assets and buying underperforming ones to restore balance. Adjust for life changes. Update your plan to reflect major life events, such as marriage, having children, changing jobs, or receiving an inheritance. These changes may affect your financial goals and risk tolerance. Strategies for long-term success. Stay disciplined. Stick to your investment strategy and avoid making impulsive decisions based on short-term market movements. Remember that long-term investing is about patience and persistence. Diversify. Diversification helps reduce risk by spreading investments across different asset classes, sectors, and geographic regions. This can protect your portfolio from significant losses in any one area. Focus on quality. Invest in high-quality assets with strong fundamentals and long-term growth potential. Avoid chasing trends or speculative investments that carry high risk. Keep costs low. Choose low-cost funds to minimize investment fees and expenses and avoid frequent trading. High fees can erode your returns over time. The importance of patience and persistence. Long-term investing requires patience and persistence. Market fluctuations are inevitable, but maintaining a long-term perspective can help you focus on your goals. Remember that time in the market is more important than timing the market. Consistent, disciplined investing over many years is the key to building lasting wealth. Avoiding common mistakes is crucial when planning for the long term. In the next chapter, we'll examine the most common investment pitfalls and how to avoid them, ensuring you stay on track to achieve your financial goals. Chapter 12. Avoiding common investment mistakes. Making impulsive decisions based on short-term market movements or emotions is accessible without a plan. Are you aware of the common pitfalls that new investors face? Learning from others' mistakes can save time, money, and stress. This chapter highlights some of the most common investment mistakes and provides strategies to avoid them. Recognizing and addressing these pitfalls can improve your chances of achieving your financial goals. Mistake 1: Lack of a plan. One of investors' most significant mistakes is not having a clear investment plan. Without a plan, making impulsive decisions based on short-term market movements or emotions is accessible. How to avoid it? Set clear goals. Define your financial objectives and create a detailed investment strategy to achieve them. Stay disciplined. Stick to your plan, even during market volatility. Avoid making changes based on short-term market trends. Mistake 2: Not diversifying. Putting all your money into a single stock or asset class can be extremely risky. Diversification helps spread risk across different investments, reducing the impact of any investment's poor performance. How to avoid it? Diversify your portfolio. Invest in a mix of asset classes, such as stocks, bonds, and real estate. Within each asset class, diversify further by investing in different sectors and geographic regions. Use index funds and ETFs. These funds provide instant diversification by holding a broad range of assets. Mistake 3. Chasing performance. Investors often make the mistake of buying stocks or funds based solely on past performance. Just because an investment has performed well doesn't guarantee it will continue to do so. How to avoid it. Focus on fundamentals. Evaluate investments based on their underlying fundamentals, such as financial health, growth potential, and competitive advantage. Stick to your strategy. Avoid making decisions based on short-term performance. Stay focused on your long-term goals. Mistake 4. Timing the market. Trying to time the market buying low and selling high is notoriously tricky and often leads to poor investment decisions. Even professional investors struggle to consistently time the market. How to avoid it. Practice dollar cost averaging. Invest a fixed amount of money regularly, regardless of market conditions. This strategy reduces the impact of market volatility and removes the need to time the market. Stay invested. Keep your money invested long term, allowing your investments to grow over time. Mistake 5. Ignoring fees and costs. Investment fees and costs can significantly erode your returns over time. High fees can eat into your profits, reducing the overall growth of your portfolio. How to avoid it. Choose low-cost investments. Opt for low-cost index funds and ETFs, which typically have lower fees than actively managed funds. Be mindful of transaction fees. Avoid frequent trading, which can incur high transaction costs. Stick to a buy and hold strategy. Mistake 6. Letting emotions drive decisions. Emotional decision-making can lead to poor investment choices. Fear and greed are powerful emotions that can cause investors to buy high and sell low. How to avoid it. Develop a plan. Having a clear investment plan can help you stay focused and avoid making decisions based on emotions. Maintain perspective. Keep a long-term perspective and avoid reacting to short-term market fluctuations. Volatility is a normal part of investing. Mistake 7. Not reviewing your portfolio. Failing to review and adjust your portfolio regularly can result in an asset allocation that no longer aligns with your goals and risk tolerance. How to avoid it. Schedule regular reviews of your portfolio, at least annually, to ensure it remains aligned with your investment strategy. Rebalance as needed. Adjust your portfolio to maintain your desired asset allocation, selling overperforming assets and buying underperforming ones. Mistake 8. Overconfidence. Overconfidence can lead to excessive risk-taking and poor investment decisions. Believing that you can consistently outperform the market can result in significant losses. How to avoid it. Stay humble. Acknowledge that investing is challenging, and that even the most experienced investors make mistakes. Diversify and manage risk. Stick to a diversified investment strategy and manage risk carefully. Understanding mistakes is essential, but continuously educating yourself is vital for long-term success. In the next chapter, we'll explore the importance of ongoing education in investing, helping you stay informed and adaptable in a constantly changing market. Chapter 13. The importance of ongoing education. The stock market is dynamic, and staying informed is crucial for successful investing. Ongoing education helps you adapt to market changes, refine your strategies, and make informed decisions. This chapter will discuss the importance of continuous learning, resources for ongoing education, and techniques to keep yourself updated on market trends and developments. Why ongoing education matters. Adapting to market changes. Numerous factors influence the stock market, including economic conditions, political events, and technological advancements. Staying educated helps you understand these influences and adjust your strategy accordingly. Refining strategies. As you gain more experience and knowledge, you can refine and improve your investment strategies. Continuous learning lets you discover new techniques and insights to enhance your investment performance. Staying competitive. The investment landscape is competitive, with many investors vying for the best opportunities. Staying informed and educated gives you an edge, helping you make better decisions and achieve your financial goals. Avoiding pitfalls. Ongoing education helps you stay aware of potential risks and common pitfalls. You can avoid costly mistakes by learning from others' experiences and keeping up with best practices. Resources for ongoing education. Books. There are countless books on investing, covering a wide range of topics from basic principles to advanced strategies. Some recommended reads include The Intelligent Investor by Benjamin Graham, Common Stocks and Uncommon Profits by Philip Fisher, and A Random Walk Down Wall Street by Burton Malkiel. Online courses. Many websites offer online courses and tutorials on investing. Platforms like Coursera, Udemy, and Khan Academy provide classes for beginners and advanced investors. These courses cover stock analysis, portfolio management, and financial planning. Financial news websites. Websites like Bloomberg, Reuters, and CNBC provide up-to-date news and analysis on the stock market and the global economy. Regularly reading financial news helps you stay informed about current events and market trends. Podcasts and webinars are excellent ways to learn from experts and stay updated on market developments. Some popular investment podcasts include The Motley Fool Money, Invest Like the Best, and The Investors Podcast. Investment newsletters. Many financial analysts and experts publish newsletters that provide insights, stock recommendations, and market analysis. Subscribing to reputable newsletters can help you stay informed and get expert opinions. Online forums and communities. Participating in online forums and communities, such as Reddit R Investing or the Bogleheads Forum, allows you to discuss investment ideas, ask questions, and learn from other investors' experiences. Strategies for continuous learning. Set learning goals. Identify specific areas you want to learn more about and set learning goals. This could include mastering a particular investment strategy, understanding a new asset class, or staying updated on economic indicators. Allocate time for education. Dedicate regular time for ongoing education. This could be as simple as reading for 30 minutes daily, listening to a podcast during your commute, or taking an online course on weekends. Stay curious. Cultivate a mindset of curiosity and continuous improvement. Always be open to learning new concepts and exploring different perspectives. Network with other investors. Join investment clubs or attend financial seminars and conferences. Networking with other investors provides opportunities to learn from their experiences and gain new insights. Review and reflect. Review what you've learned and reflect on how you can apply it to your investment strategy. This will help reinforce your knowledge and ensure you're continuously improving. With a commitment to ongoing education, let's focus on building a diversified and resilient investment portfolio. In our final chapter, we'll put everything together and provide a step-by-step guide to constructing a robust investment portfolio that can withstand market fluctuations. Chapter 14. Building a resilient investment portfolio. Building a resilient portfolio involves diversification, regular rebalancing, and maintaining a long-term perspective. A well-constructed portfolio can help you achieve your financial goals while managing risk effectively. In this final chapter, we'll summarize critical strategies discussed throughout the book and provide a step-by-step guide to constructing a robust investment portfolio. Step 1. Define your financial goals as the first step in building a resilient portfolio. Clear goals will guide your investment strategy and help you stay focused. Consider both short-term and long-term objectives, such as retirement savings, education funding, significant purchases, example, a home or car, wealth accumulation. Step 2. Assess your risk tolerance. Understanding your risk tolerance is crucial for determining your asset allocation. Your risk tolerance depends on age, financial situation, investment experience, and emotional response to market volatility. A financial advisor can help you assess your risk tolerance and develop a suitable investment strategy. Step 3. Choose your asset allocation. Asset allocation involves spreading your investments across different asset classes, such as stocks, bonds, and real estate, to balance risk and reward. A diversified portfolio reduces the impact of poor performance in any asset class. Here are some standard asset allocation models based on risk tolerance. Conservative portfolio. Higher allocation to bonds and cash, lower allocation to stocks. Suitable for risk-averse investors and those nearing retirement. Example: 30% stocks, 60% bonds, 10% cash. Moderate portfolio. Balanced allocation to stocks and bonds. Suitable for investors with a moderate risk tolerance and a medium-term investment horizon. Example: 50% stocks, 40% bonds, 10% cash. Aggressive portfolio. Higher allocation to stocks, lower allocation to bonds and cash. Suitable for risk-tolerant investors with a long-term investment horizon. Example: 70% stocks, 20% bonds, 10% cash. Step 4. Select your investments. Once you've determined your asset allocation, it's time to select specific investments. Here are some guidelines. Stocks. Choose a mix of large, mid, and small-cap stocks across various sectors. For geographic diversification, consider including both domestic and international stocks. Bonds. To balance risk and return, invest in a mix of government, corporate, and municipal bonds with varying maturities. Mutual funds and ETFs. Seek out affordable choices that match your investment strategy, as these funds provide immediate diversification and are overseen by experienced portfolio managers. Real estate. Add real estate investment trusts, REITs, or direct investments to your portfolio for additional diversification. Step 5. Implement dollar cost averaging. Dollar cost averaging involves investing a fixed amount of money regularly, regardless of market conditions. This strategy reduces the impact of market volatility and removes the need to time the market. By consistently investing, you can accumulate more shares when prices are low and fewer when prices are high. Step 6. Regularly monitor and rebalance your portfolio. Regularly monitoring your portfolio ensures it aligns with your financial goals and risk tolerance. Here's how to do it. Set a review schedule. Review your portfolio at least once a year. If your circumstances change significantly, more frequent reviews may be necessary. Evaluate performance. Assess the performance of your investments relative to your goals and benchmarks. Rebalance your portfolio. Adjust your asset allocation to maintain your desired balance. This may involve selling overperforming assets and buying underperforming ones. Step 7. Stay informed and adapt. Staying informed about market trends and economic indicators helps you make informed decisions. Continuously educate yourself and be open to adjusting your strategy as needed. Remember that long-term investing requires patience and discipline. Step 8. Consult with a financial advisor. A financial advisor is there to offer tailored guidance and assist you in creating a well-rounded investment plan. They can help with determining how to distribute your assets, selecting the right investments, and managing your portfolio over time. Final thoughts. Building a resilient investment portfolio is a dynamic process that requires careful planning, regular monitoring, and ongoing education. Following the steps outlined in this chapter, you can create a robust portfolio that aligns with your financial goals and withstands market fluctuations. Staying disciplined, informed, and adaptable is critical to successful investing. As you continue your investment journey, consider exploring more advanced topics and strategies to enhance your financial growth and security further. Your adventure in the stock market is just beginning, and there is always more to learn and discover. By now you have a comprehensive understanding of stock market investing. Remember, the journey doesn't end here. Continuous learning and adapting are essential to your success. Keep investing in your knowledge and your portfolio. Your future self will thank you. Thank you for listening. Elevate your learning journey with our channel by subscribing today. Each video we create is designed to challenge, inspire, and enlighten. By subscribing, you ensure you're up to date with the latest content and support our quest to make learning accessible and engaging. Your feedback helps us tailor our content to serve you better. Join the conversation below, and let's learn and grow together. Let's explore the limits of what we can achieve together, be well and thrive,